Welcome to RP-Data's December market update, where we provide an overview of the RP-Data RISMark Home Value Index results for October and update our analytics on other key housing market indicators. The October index data showed Australian home values continue to decline over the month, falling a further 0.5%. Capital city home values are now down 4% from the December 2010 peak. However, the declines vary from city to city, with a fall of 9.5% in Brisbane from the market peak, which was back in March 2010, to Canberra, where dwelling values have fallen by just 1.1%. The October results mark the 10th consecutive month-on-month decline in Australian home values. That's the same number of months we saw property values fall during the GFC, when values were down 2.7% from peak to trough on a seasonally adjusted basis. Despite the fact that values continue to fall, RP-Data's estimate of transaction volumes has seen some improvement over the month of September, with 35,400 sales recorded. That's the highest transaction volume since March earlier this year. The improvement in the number of sales comes on the back of higher consumer sentiment levels and several months of improving housing finance volumes. Even though we've seen a rise in the number of homes selling, transaction volumes remain 9.5% below average nationally, based on the 5-year average, and about 6.3% below average across the capital cities. Regional markets have shown a slightly better result than capital city markets over the past year, with house values outside the capital cities down by 3.4% over the 12 months to October, compared with a 4.7% fall in house values across the combined capital city markets. Across the broad price segments of the market, it is premium homes where values continue to be hit the hardest. Dwelling values across the most expensive 20% of capital city suburbs were down 2.4% over the 3 months ending October, compared with a 0.8% fall at the most affordable end of the market and a 0.9% fall across the broad middle 60% of capital city suburbs. We're likely to see the top end of the housing market underperform until there is some stability around equities markets and some improvements in business confidence, while the more affordable markets are likely to be much more responsive to interest rate cuts and the broad improvement in consumer sentiment. Market conditions still well and truly favour the buyer. The number of homes advertised for sale across the country is currently at record levels. Over the past 4 weeks, RP-Data were tracking around 318,500 unique properties advertised for sale. That's 29% higher than at the same time last year. The number of new listings being added to the market has seen a slight increase over the past month. However, the high stock levels can mostly be attributed to the fact that homes simply aren't being absorbed at the same rate that they're being added to the market. Just like the performance in home values, from city to city, the number of properties being advertised for sale is quite different. Perth is actually showing fewer homes for sale now than at the same time last year, and Brisbane listings are only 7% higher than what they were a year ago. The improved effective supply levels in these cities will be a welcome improvement by vendors trying to sell a property. In Melbourne, the uplift in total properties being advertised for sale is much higher at 49%, and there are 35% more homes available for sale in Sydney than at the same time last year. With such a high level of stock available for sale, it should come as no surprise that vendor discounting and the average selling time remains high. The typical capital city house is taking 55 days to sell, and vendors are discounting their initial asking prices by 6.3%. From a positive sense, it does appear that these indicators are now levelling. Average selling times have been between 51 and 58 days since June this year, and vendor discounting levels across the combined capital cities have shown some improvement since peaking at 7.3% in June earlier this year. Now for a quick roundup of the capital city markets. Australia's largest capital city housing market, Sydney, has maintained its comparative resilience to falling values. Home values are absolutely flat over October, recording no change. Sydney house values are now down 2.1% over the past 12 months, while unit values have actually seen a modest improvement, up 0.9%. Melbourne's housing market, which has shown the most significant capital gains over the past 2 growth cycles, has continued to slow at a more rapid pace than most other cities. Dwelling values were down 2.1% over the 3 months ending October, which is the second weakest result after Brisbane. Melbourne house values are now down 5.5% over the past 12 months, and unit values are down by 5.2%. Melbourne's rental markets have also been seeing limited growth. Rents are up just 2.2% over the past year, and gross rental yields remain the lowest of any capital city after capital gains outpaced rental growth during 2009 and 2010. After showing some signs of improving conditions last month, the Brisbane housing market results have remained weak over the month of October. Dwelling values were down a further 1.6% over the month and 2.8% over the quarter. The Brisbane unit market is faring considerably better than the detached housing market. Unit values are down by a much more modest 1.4% over the past 12 months, compared with a 9.3% fall for detached houses. The widening price gap between Australia's three largest capital cities is placing the Brisbane housing market in a fairly strategic position from an affordability perspective. Brisbane house prices are now 23% lower than Sydney's and 12.1% lower than Melbourne's. Adelaide's housing market has also been a reasonably strong performing market. Dwelling values are now down by 5.2% over the past year, with house values down 5.5% and unit values down 3.9%. Adelaide's rental markets have also been quite weak over the past year. Weekly dwelling rents have fallen by 0.5% over the last 12 months. Gross yields for houses are now right on the capital city average of 4.3%, while yields on a typical Adelaide unit are slightly lower than the capital city average of 4.8%. Perth, which for a long time was the weakest housing market across the capital cities, has been showing some consistent improvements in the rate of decline. Perth dwelling values fell by 0.8% over the month of October, and values were down 1.2% over the 3 months to October, which is a slightly more resilient result than the combined capital city average. Thanks to some strong rental growth, particularly across the detached housing market, Perth rental yields are showing consistent improvements. The gross rental yield on the typical Perth house is now 4.6%, which is higher than the capital city average, and gross yields for Perth units are slightly below average at 5.0%. In the southernmost capital, Hobart values have seen a 4.0% decline over the year to September, with a slightly larger peak to current fall of 5.4%. Rental markets are also quite weak across Hobart. Weekly rents were down 1.6% over the past year. However, despite the fall in rents, gross rental yields remain slightly higher than the capital city average for houses and right on par with the capital city average for units. Hobart houses and units are both returning a gross yield of 5.1%. Housing values in Darwin have been slipping backwards after a strong growth run over the past decade. Over the year, Darwin dwelling values are down by 3.1%, which is a less substantial fall than the combined capital's average. Darwin rents are up by 4% over the year after rents appreciated by 9.9% per annum on average over the past 5 years. The historically high rate of rental growth places Darwin rental yields as the highest amongst the capital cities, with houses returning 5.3% gross and units 5.8% gross. Canberra housing markets have remained the most resilient of any capital city, with dwelling values up by 1.6% over the month of October and down just 1.1% over the past 12 months. There is some speculation that federal government budget cuts could potentially affect the Canberra housing market. If we see a material fall in employment levels in the region, then it stands to reason that the Canberra housing market will be negatively affected. Currently, the market is exceptionally tight from both a value and a rental perspective. Next month's results, which are due out on December 30th, will provide the first indication as to how the Australian housing market has responded to the 25 basis point interest rate cut announced on the 2nd of November. The market is certainly very interest rate sensitive, however, it may take further rate cuts to reverse the declines being seen in home values. At the very least, we would expect to see some ongoing improvements in transaction volumes on the back of lower interest rates and more affordable housing prices. Additionally, if consumer confidence continues to show improvements, as we've seen in September, October and November, that should assist in a recovery in transaction volumes. Interest rate futures markets are still indicating the cash rate will fall to around 3% by mid-next year. That's suggesting interest rates may go as low as what we saw in April 2009, when the variable mortgage rate briefly fell to 5.75%. That outlook strikes me as being quite bullish. However, a further 50 basis point cut to interest rates doesn't seem to be that much out of the question. As always, more detailed information about Australia's housing markets can be found at www.rpdata.com.